welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. And this is Trading Places Live. It is Tuesday, February 22nd, 2022. And I'm pre-recording this Trading Places Live for just a little bit later this morning. It's been a wild ride overnight on futures. Futures last night down several hundred points on the Dow. The NASDAQ on a percentage basis was down even further. Down the highest I saw was down close to 400 in terms of futures overnight. But this morning things have changed considerably, and it was interesting because I was having an event last night with our members at Earnings Beats. We were selecting the 10 equal weighted stocks to go in each of our portfolios, and at the end of the event, futures had opened, and of course futures were way down. And I made the comment, with the volatility index being what it is right now, that heck, we could be up that, in the morning. Things could reverse. And while we're not higher, we've still got time. I mean, still a couple hours away from the opening bell. We have reversed off of those huge losses. The S&P 500, which looked like it was going to easily break below 4,300 neckline support based on the futures last night. Last time I looked, we're flat. So still hope that we hold on to this next neckline support. Based on where we are right now, it does look like we're going to hold it at the open, and we'll see how we go throughout the week. There are still a lot of earnings reports coming up. We'll talk about those some later in the show. Let's go through today's agenda with you. First, we will start off, as we always do, with the daily market recap. So I'll go over Friday's action. Then we'll get into talking technically, chart lists, earnings spotlight, and the three you must see. Before we get into any of that, let me take you over to earningsbeats.com. For those of you who are maybe new to the show or don't know that much about us at Earnings Beats, if you go over to earningsbeats.com and then scroll down, we do have a free newsletter. That's probably the best way to get to know us, along with listening to the shows and reading my blogs at StockCharts. If you subscribe to our Earnings Beats Digest, very simple. All you need is your name and email address. No credit card required. You can unsubscribe at any time. Just fill out those your name, email, hit that subscribe button. Our newsletter, which is published 3 times a week, Mondays, Wednesdays, and Fridays, will be shipped out to you. It's a very, very easy read, usually just a couple paragraphs and a chart. And they're designed just to teach some of the things that we look at Earnings Beats. So normally it's going to be earnings related, relative strength, candlesticks, gaps, trend lines, moving averages. I mean, those types of things are things that we really focus on at Earnings Beats. Also, we are kind of unique in that we look at the fundamental information as well as technical. My background, having practiced in public accounting for 20 years, I do believe that it's important to have management that you can trust. And one of the ways you can trust them is they give their predictions on what they're going to do, or call them promises, whatever you want. But they tell the investing world, hey, this is what we're looking for in terms of our revenues, our earnings. Analysts come up with their own ideas. And when you come out with your earnings report, it helps to be able to show that you can beat those expectations on a regular basis. Apple, one of the best performing companies in the history of the US stock market, has a history of beating estimates. They guide conservatively, and then they come through and they beat estimates. Analysts can count on those earnings being strong, generally speaking. And as a result, the company is treated with a lot of respect in terms of its price over the years. Anyhow, we get into a lot of those types of things, but if you subscribe to the EB Digest newsletter, not only will you get the newsletter 3 times a week, but when we have free events, we reach out to this community, provide a room link so you can come in and join us for those events. So it's a great free way to learn more about the market, maybe add to what you already know, and to do it for free. All right, let's move on to the daily market recap. So on Friday, we saw the Dow Jones Industrial Average finish down 233 points, the S&P 500 down 31. Relatively speaking, another rough day on the NASDAQ, down 169 points. That was your worst performing index. The only one of these 5 that I'm showing that lost more than 1%. Mid caps lost almost 0.5%. Small caps exactly 0.5%. As far as the individual sectors go, Consumer staples, the only winner on Friday. Consumer staples, which has been outperforming the major indices. You can look at just take a look at the S&P 500, and you can see how we're mostly going sideways with this head and shoulder top, left shoulder neckline, head, right side of the neckline, right shoulder, and here we come down. That's why I was referring to that 4,300. Look at staples. While we're putting in these equal lows and threatening to break down, look at this chart. It looks like we're still in a bull market. So XLP, very defensive, but also can be pretty good protection relative to the S&P 500 during a cyclical bear market. So I would expect that to continue. I don't know if the staples remain in an uptrend, but I do think relative to the S&P 500, I think we'll see outperformance there. All right, so let's turn our attention to the weakness that we saw last week, and particularly on Friday. Technology down more than 1%, dropping back down near its neckline. Industrials also getting close to a neckline here, dropping a little bit more than 0.8%. Communication services just flat out bearish. I mean, we've been going down now for several months. This is the worst performing group if you look back over the last 6 months or so, and it had another rough day, down more than 0.75% on Friday. Healthcare down 0.75%. It too has some pretty key support, down just below the 125 level that we need to watch. Well, Monday, of course, we were closed. I hope everybody had a nice extended holiday weekend. We were very busy at Earnings Beats. We had our third and final of our February educational series. If I take you back over to our site here, you can see here we had the top 10 picks. That was last night, but we had a February educational series that started back on Saturday, February 5th. We also had an event Saturday, February 12th, and another one Saturday, February 19th, which was just this past Saturday. And the three events, we talked about the January effect. So of course, that's where as goes January, so goes the year. If you've heard that saying, there's a lot of truth behind it. Doesn't happen every year, but the tendency is that if you've had a rough January, if over the last 72 years, going back to 1950, if if January places in the bottom quadrant of Januaries, so that would be if you're one of the worst 18 years or one of the worst 18 Januaries over the last 72 years, that would be the bottom quadrant, bottom 25%. Chances are you're not going to have a very good balance of your year. And I'm not talking about including the January performance. Forget about the January performance. I'm talking about from February to December, through December. If you've had a bad January, the chances are you should definitely lower your expectations for performance, the balance of the year. And this is coming on the heels of a lot of warning signs that I've been talking about since back in December. I had a number of articles back in December on my blogs talking about it at Earnings Beats. You can kind of see some signals that at least alert you to the fact that there's a greater chance that the market is going to struggle. And that's all it tells you. You never have a guarantee, but there's always signs that can tell you when to maybe, a weather analogy, when should you take your umbrella outside? If you look outside and you see it beautiful blue skies, and then you look on your phone or on your computer and you see the weather forecast for the day and it's 0% chance of rain, it's going to be beautiful, sunny, warm, probably can leave that umbrella at home, right? The weather is telling you that chances are you're not going to need that umbrella. However, if there's a 70% chance of thunderstorms in the afternoon and you're getting ready to go out, that's a different story. You might want to grab that umbrella. Same thing looking at the stock market. And I know I use some of these cheesy analogies from time to time, but I think they're pretty meaningful and worthwhile. Anyhow, when you're looking at the market, there's sometimes you just want to have that umbrella. And I think coming into 2022, that was one of those times. And for me, it just means lowering my risk. I just don't want to have the same risk that I have when I believe we're in a healthy advance within a secular bull market. And by the way, what we're going through right now, and I've said this many times, I'll keep repeating it. I believe we are still in a secular bull market. If you look back in the 1950s and 1960s, we had a beautiful secular bull market, and we had 5 or 4, maybe it was 4, I don't know if it was 4 or 5 cyclical bear markets within the secular bull market. You can have short-term 20, 25, 30% drops within a longer term uptrend. You don't go up every day in a secular bull market. It's okay to pull back. And in fact, I think it would be really healthy for the market over the next couple of months to see further downside. I don't like to see anyone lose money, but at the same time, the market needs a break after the huge run it made in 2020 off the pandemic low in 2021, setting its all-time high on the S&P beginning in 2022. These are things that need to be corrected. So anyway, I just think right now you've got to be really careful in the market. Looking at the 10-year Treasury yield, first of all, economic news out today. We got the December Case-Shiller Home Price Index. November came in at 1.2%. We're expecting December's report. And I know it's February. This is a delayed, we're not that far from March now. So we're looking way back in the rearview mirror. But December Case-Shiller Home Price Index is expected to rise 1.1%. So at least through the end of the year, it looked like the housing market's still pretty strong. Also getting the December FHFA House Price Index. That tends to go along with the Case-Shiller Home Price Index. And the numbers are very similar. November rose 1.1%. December expected to rise 1.0%. Then we've got the February PMI composite. That expectation is for 51.9. That'll be out later this morning, along with the February consumer confidence, which in January was 113.8. And if you remember back before the pandemic, it was up in the 130s. So it's come down a lot, even though the market's had a huge run. Consumer confidence, 113.8 in January. This morning, we're expected February's to drop to 110.0. So not great there. We'll see how all that comes into play. Looking at the 10-year Treasury yield here, we had a big move. We broke above 2%. We're pulling back. The question I have is, can we hold on to this rising 20-day, which is at about 1.90%? And looking this morning, we were up about 1 basis point to about 1.94%. So we got just a slight move to the upside, but I'd watch 190. And then also we broke out right here above about 187. So if we go a little bit below the 190 level, I'd be looking for a reversal around 187. So the new range for me, at least short term on the 10-year Treasury yield, would be about 187 to the downside up to about 205 top side. And I imagine we're going to break to the upside. If you fear inflation, if you think inflation's a problem, and you think it's going to last for a period of time, the 10-year Treasury yield should be moving up. And because it's kind of convoluted and complicated, but the 10-year Treasury yield is a pretty good indicator of mortgage rates. And when mortgages are closed, they're packaged and sold to investors. And the investors are going to require a certain return on their investment, or they're not going to buy the loans. As inflation goes up, their expectations are going to go up for returns, which in turn is going to send the longer term end of the yield curve higher, if the market truly believes that inflation is a longer term problem. So if the 10-year Treasury yield doesn't really budge much from where we are now, and the Fed starts hiking short-term rates, that's going to squeeze interest margins on banks. Their short-term, Fed funds rate, as those move up, that can impact, the really short-term rates like, credit cards, things that are variable in nature. They're going to be impacted more by the short-term rates. Also, deposits, the rates that banks pay on deposits are going to be impacted a little bit more by these short-term rates. So my point is, if the market doesn't fear inflation and the Fed raises, it is going to start squeezing banks, and that yield curve, the spread between the longer term treasuries and the short term, are going to begin to tighten. And it's almost like cutting off circulation in your body when you do that. And that's what, when you talk about an inverted yield curve leading to recessions, that's generally what happens, is you start cutting off the circulation in banks. And they don't want to lend. You don't want to lend money and take risks while the other side of the equation, the interest expense is going up. So this is going to be a balancing act for the Fed in 2022. I'm okay with the first rate hike, just to basically let the markets know that, hey, we are here and we're ready to do whatever we need to do. But going on record and announcing all these rate hikes down the road, and then you got Goldman Sachs coming out and saying there are going to be 7 of them, whatever. Don't even get me started on Goldman Sachs. Let's just move on. 10-year Treasury yield. Let's just watch short term, 187 to 205. All right, moving on to talking technically. So, when we look at the market, I mentioned the neckline. If you've been listening to me at all, you've probably heard this over and over and over and over again. This neckline's a big deal. The S&P 500, left shoulder, neckline, head, right side of the neckline, 4,300 is where it comes in, right shoulder, and then coming back down. Now, we could do a couple of things here with this neckline. I was asked, and I've been asked before, should you be looking at intraday or should you be looking at closes when you look at head and shoulders? Well, the first thing I do is look at the left side of the neckline for a close. And if I don't have a lower close, then I just draw this line straight across. And I'll tell you why in a second. But here, left side of the neckline, that's based on the close over here. Now, if I have a close that goes below this level, then I'll drag this down to wherever the close is. But I'm not going to drag it down to the intraday because to me, the close is the most important thing on the chart. And so when you look at just the intraday, you're getting a breakdown that's way down at 4,200 when I drag that down right here. Then you got to go below 4,200 to actually get a breakdown. I think the breakdown is a close below 4,300. That's when you're losing closing price support. To me, that's the biggest level. Now, the problem is when you have an uptrending neckline, like if we look at the close here, so if we're drawing the line from this close to this close, it's uptrending. And the problem with this is, let's say we close at 4,300. It breaks the neckline. So anybody who's following the pattern says, hey, the pattern's been broken. We're at 43.05. Well, we still haven't broken the left side, the price support over here, which is at 4,300. So to me, that's just going to give you a ton of false breakdowns. And, I was mentioning during the, I don't remember when it was, I have so many webinars and so many shows and all that, but I mean, look at this. Sometimes I see technicians do this, and this drives me crazy. The upsloping head and shoulders. That's an uptrend, by the way. That's not a head and shoulders. So what? You get down here and you break below this low. What does that mean? I mean, we broke out right here at about 39.80. So a normal test would be go back and test this breakout, which we didn't even do that. But what does this neckline do? If we break this trend line, what's that tell us? I think it's absolutely ridiculous to want to try to draw head and shoulder tops throughout uptrends. It's a waste of time. Was this a neckline? Left shoulder, neck. I mean, this is like, I don't know, a lot of deformity on this chart or something. It doesn't look like a head and shoulder top to me. And when we broke down here intraday, does that trigger something bearish? Well, doesn't look like it. Went right back up again. So it's not just the pattern itself. It's about executing the pattern. It's about having the type of volume that confirms that pattern. If we lose 4,300, for me to believe that we're going a lot lower, that volume needs to escalate. I want to see 3 billion shares or more. 4 billion would be even better on the S&P on that breakdown. Then I believe the pattern has been established and confirmed. And then you can start looking for the measurement, which would be another 500 points. So those are some of the things that I would be looking at in a head and shoulder pattern. Now the NDX, the NASDAQ 100, look at that. We've already had lower lows. So now we do have that down sloping neckline. And if we break this recent low right here, I don't even need to break the neckline. If I break this low and go to a new low, I am going to be much more bearish. And we are right on the threshold of that. And what could trigger it? Well, the large cap growth. Here's the IWF, iShares Russell 1000. Watch this. If it breaks down, I think the market's in big trouble. Here's another one, large cap growth index. This breaks down, beware. All right, let's do a little chart list. Let's look at the chart list. So if you're not familiar with Earnings Beats, if you're not a member and you've never tried our service, you may not be familiar with what we do. But we do a lot of research for our members. We put together chart lists over at StockCharts. And if you're a member at Earnings Beats, you can view all of these chart lists. You can bring them up, look at the charts one at a time. if you're a member at StockCharts, Extra or Pro level, you can take our chart list and you can download them right into your own account. First of all, I think the StockCharts platform is awesome. I've been using it for many, many years. The reason that it's part of our platform and the reason that it's part of our research is because this is the platform I use. We don't require our members to have StockCharts membership, but if you are a StockCharts member, you can get so much out of our service. This entire chart list, our strong earnings chart list, which is really what I consider our flagship chart list. I mean, it's really the foundation of what we do at Earnings Beats. It's the foundation of who I am as a trader. I put together stocks on this list that are companies on this list that have beaten Wall Street estimates as to both revenues and earnings in its latest quarterly report. These are companies that are all liquid in terms of the number of shares they trade. I don't want our members looking at stocks that are not liquid. So individually, you might be okay with a stock that trades 50,000 shares a day or 100,000. These are generally going to have at least 200,000 shares a day traded. So we're not going to put anything in these chart lists where our members are going to, if a number of members want to get in, we want to make sure there's liquidity for those to want to, for those who want to get out. And then also I look at these technically because I want to see something that looks fairly solid technically. Either the stock's doing well, it's showing relative strength, or maybe its group is showing relative strength and that stock may not be doing great, but because its group is strong, I'm going to watch it to see if the individual stock begins to show relative strength. So there are a number of reasons why these stocks go on this chart list, but it provides our members. I mean, you can see there are a lot of companies on this list, and this is really low in terms of the number of companies relative to what we normally see. But because of the impending or current cyclical bear market that I believe we're in, a lot of companies are struggling to meet and beat, not meet, but beat their revenue and earnings per share estimates. So we're not seeing as many companies, or the companies that are beating, I'm looking at the charts and the charts look horrendous because of the breakdowns we've been seeing. And so they're not being included in this list. Now, one of the beauties here is I get questions sometimes, well, what would you trade in this kind of market? How do you trade a market that is starting to look more bearish? If you don't want to short, where do you go to look for strength? Well, when you pull up our strong earnings chart list, you can see this is kind of a basic look. If you click on the columns here, you can pull up the sector, you can pull up the industry group, you can pull up the scooter, and let's just take a look at those three. Now, all of a sudden, you can see what groups are in this chart list, what industry groups, what sectors. What's the scooter? This is a relative strength score. This is exclusive to StockCharts. It's their StockCharts technical rank. So it's ranking small cap stocks against other small cap stocks, mid caps against other mid caps, large caps against other large caps, based on a formula that was developed by John Murphy. I would say the one limitation it has is that it's only really going to look back at technical performance over the last 5 to 6 months. So it's not going back a year. It's not looking at relative strength over a long period of time. So just keep that in mind. The scooter is going to be based more on like a 5 to 6 month read on stocks relative to other stocks in their asset class. So when I'm looking at this, right now, this is just in number order, and I add these stocks in chronological order. So as they report earnings, they get added. As they come up for their next earnings, they get deleted. So if American Eagle comes out with their next earnings report next week, I will delete this from our list. And then once they report, if they report good results, and I go through and I check them, and I like the chart, and they beat Wall Street estimates, then I may add them back. And when I add them back, they're going to go in. If they were the next stock to be added, they would go in as number 00669. So it's going to basically be in the order of earnings when the earnings reports come out. So the top ones are going to be earnings that came out probably 2.5 months ago, because I try to take these off. I update this chart list probably once a week to once every 2 weeks. Somewhere in that 7 to 14 days is when I try to update these. During the heart of earnings season, it's really hard because there's so many reports coming out. But anyway, once this gets removed, then we see the next report, and then it gets added back. Now, one thing I think that would be cool to do is to take a look at the scooter and just pull up in scooter order. Let's see what sectors and what industry groups are producing these stocks that have great scooter scores. These are top of the line: materials, energy, healthcare, industrials. There's one technology stock, semiconductors, but for the most part, you can see there are a lot of energy, materials, and healthcare and financials starting to creep in. That's because those are the areas that are working right now in the market. So if you want to find the great stocks, we got the list for you right here. The best performers, the best fundamental, best technical within the groups that are leading the market. So this is a great place to start. Another chart list that I like is the strong future earnings chart list, which again, you go in here and I would update this for the sector, industry, and scooter. And then you can sort this by scooter. But essentially what the strong future earnings list is it's any company that has excellent relative strength, but is not on the strong earnings chart list. So there will be no duplicates between what's on the strong earnings chart list and what's on our strong future earnings chart list. And I just say strong future earnings because if a stock has really good a scooter score, but it's not on our strong earnings chart list, one of a couple things. Number one is it's either just been removed from our strong earnings chart list because it's going to be reporting earnings soon. That's one possibility. Or it's just a company maybe that missed recently, but for whatever reason, Wall Street's giving them a pass and they continue to trade with strong technicals. So this is a separate chart list, but these are just two chart lists out of many that we do for our members. But if you look at the edit, pull it up in edit form, it'll tell you how many are on this chart list. We have 358 companies on this chart list. If I pull the strong earnings chart list up, we have 366. None of them are the same. So between these two lists, we have about 720, 725 companies. That's a lot that we've already vetted. We've gone through and done the research for you. So anyway, I think that's pretty awesome. Let's move on to earnings spotlight. Just have a few more minutes here, and I wanted to talk about a couple of these earnings real quick. Macy's came out with a great report. Macy's beat on their top line, $8.66 billion versus $8.43 billion. Bottom line, $2.45 versus $1.96. They announced a $2 billion buyback, and then they raised their dividend from 15 cents a share to 0.1575. So it's a 5% dividend increase. The result, last time I looked, Macy's was up. Let's pull this up. Macy's was up 7, almost 8%. Well, now it's up 6.9%. So it's pulled back a little bit. On the chart, though, we need to get through $28. And right now, this morning, we're trading at $27.47. So that will be an interesting, that'll be an interesting level to watch today. Another chart I'd bring up is ICLR down 3%, 2.5%. They missed on revenues, but they did beat on the bottom line. They've been getting sold off, though, pretty hard heading into their earnings. The one I wanted to bring up was Tempur-Pedic, TPX. This one, Tempur-Pedic's missed by a mile on their revenues, $1.36 billion versus $1.45 billion. Missed on the bottom line, 88 cents versus 95 cents. They guided in line, stock down 9% pre-market. Look at the selling that's been taking place on the stock. Wall Street knew this was not going to be a good report, which is why you have to follow the charts. All right, moving on to the 3 you must see. Let's wrap this thing up. The 3 you must see, I'm going to go through very quickly. XLK rolling over needs to hold about 147. XLY rolling over needs to hold 175. And the XLC, these are the 3 biggest areas of the market, or the 3 big aggressive areas. This is broken down as well. So I think we got problems, and they're only going to get worse if we struggle into today's action. Again, futures are down. We'll see what happens into the close or into the opening bell. Listen, everybody have a great day. Be back tomorrow over at Earnings Beats for your next Trading Places Live. Take care. Happy trading, everybody.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.